Yeah, people close to the space have at least expressed a lot of skepticism to me about Bitcoin Lightning. But again, I don't want to offer a comment just because I just don't know enough. You know, I'm going to spend some time researching it on a long to-do list of things I have to do. But you know, there's other solutions too, right? I mean, I think there's, you know, Bitcoin has a ways to go on lots of things, encryption and security as well. Like, you know, again, I don't think we're going to see quantum supremacy anytime soon. But I think that, you know, that's still another question of, you know, can you get a quantum safe algorithm? Because ultimately ECC is itself, you know, known to be somewhat unreliable occasionally. So, you know, I'm not saying Bitcoin's hackable today, but it's the kind of thing that does make you wonder. So inevitably, there's going to have to be a lot of upgrades to Bitcoin. And I think that one of the problems with Bitcoin is just the practical upgrading consensus is pretty difficult. I think in an emergency, you know, you could form a consensus pretty quickly. But I think that, you know, you don't have to look very far to see Bitcoin Cash, Bitcoin SV, other things like that, you know, clearly this isn't an easy piece of software to upgrade. It's not as simple as a GitHub repo. And that's kind of what it was intended. That's by design, right? That's not a bug. That's exactly the way it was supposed to be. And the problem is, if you have a technology that needs to rapidly iterate, you know, this isn't sort of the place you want to be. And we're seeing that with Ethereum, right? I mean, Ethereum's sort of a cluster for the same reasons. And, you know, I think like having like a roadmap where you slowly decentralize over 3 to 5 years may actually be better than the other way around. Is as bad as that medicine may taste, your alternative is to sort of get it right by putting it in stone. And it's like, ask 5 programmers to sit down and write a repo that they never ever change. You know, it's sort of
good luck with that.
Yeah, it's basically impossible, right?
And like you see all these people who are pounding the table and saying, "Oh, we're the next like Ethereum killer," and it's like, "Oh yeah, that sounds great on your white paper." And then you see the real world use case like Solana and AVAX, and you have to see like, can you handle even like half of their user base? And over again, that's just not the case. So you could talk as much smack as you want about ETH and all these other ones, but at the end of the day, look at what's happening with Solana. Look at what's happening with AVAX. Like, they just can't hold water when it comes to even handling like part of their traffic. I mean, I can't even count like a week that's gone by without Solana, their TPS going like sub 500.
Yeah, and that's not without you trying to crash the network. By the way, pretty good trade idea, right? Short of the crypto and then go DDoS their server. I'm sure it's already happened.
It's a really comparable short anytime their network goes down, but it's like, you know, it's funny trying to like do any perp shorts on against Solana when their network's going down. So it's like you have to be on some kind of exchange and not using Solana to short their network while they're going down.
I would never do something like that, but you know, I'm sure other people don't have that kind of ethical barrier. Yeah. There's a CNBC reporter in here. I gotta block them. It's like CNBC is the most cancerous, toxic, like media establishment there is.
As long as it isn't Lori Siegel, because she is wildly uneducated when it comes to crypto, yet she's their main person to handle that kind of stuff. It's pretty funny.
I don't think there's anybody educated at CNBC. It's like I've complained about this a number of times. Like a lot of these media organizations, they, especially televised ones, they optimize for looks more than they optimize for brains. Like I've had friends interview at major media companies, including CNBC, and they were like basically told they're not pretty enough. I mean, if you look at their TV show all day, you know, it's in essence, you know, optimized for their user base, which is hedge fund guys and brokerage firms sitting around. And basically, if you look at what they put on TV, you'll know exactly what I'm talking about and be as diplomatic as I can. But, you know, most of CNBC is watched while it's on mute anyway. So it's sort of like a funny thing. Because,
background.
You know, it's basically just background. So, you know, again, it's
just
sort of
say something and then inverse him.
Yeah, exactly.
So somebody that's experienced all the ups and downs in life, as you have, has your opinion on money changed over time? Do you think it's more money, more problems? Do you think you're more happier when you have more money? And you can buy experiences, and then if you agree you're happier when you have more money, like maybe talk about the best cost benefit for things that you found personally that bring you happiness.
Yeah, certainly everybody's different, but I can only speak on me personally. And I definitely think there's sort of a weird curve with money. It's kind of maybe a U-shaped upside down U, or right side up U, depending on your what you're measuring on the y-axis. But I think, if you absolutely have no money, you can be pretty miserable. And that's thankfully just sort of a condition that's getting eliminated, whether it's by technological singularity or by welfare, or maybe a little bit of both. I do think there's sort of an optimal amount of money, and that, chasing more of it can bring you a lot of unhappiness. If you like what you do, and what you do is building software, you're going to get pretty rich pretty fast. You can kind of even try to like not get rich, and it'll still happen by accident. The software business is a fantastic business, and very few people that participate in it can avoid wealth. It's really that good. Like, I had a software startup that was unfortunately terminated due to my incarceration. And I told a joke about the wrong person, so I went straight to jail. And the developers of that project, every single one of them found, mid 6-digit jobs very quickly. So like, they're all doing really amazing, and they're all tremendous developers to begin with, software engineers, whatever you want to call it. And ultimately, I think that if you chase too much happiness, you can get miserable. For me, I think, thankfully, the things that I love to do happen to be, really create a lot of wealth. But at the same time, like, it's your choice whether you commercialize them or not. I think 𝗬𝗢𝗏's actually a pretty good point on this topic, where, he kind of like was pretty. I think it's admirable how he kind of like didn't really try to shove all the money in his pocket, and that's sort of saying something. And it's probably a good thing to do as a younger person. So I do think, trying to make too much money for money's sake is a very insane thing to do. If you love to develop drugs like I do, or you love to design software or write software as well, like I do, or manage people, all those things are kind of profitable endeavors. You can't really avoid that. But if you love to do art, that may not be a profitable endeavor, whether it's music or what have you. Like, my friends in the rock world don't make any money. They're constantly, in trouble for money, and tons of other music genres as well. So, but they still do it because they love it. You have to love it if you want to tour the country in a van, where you don't get to shower and you're stuck with 4 people in a really small space. I should hope you love it, but there's something about, music that people love, that they're willing to do it regardless. So, I think more money, more problems is probably right. Again, the people I've met that just try to make as much money as possible end up, they're either kind of psychopathic and they have very little love in life, and pretty dangerous people, or end up sort of seeing the light and sort of doing things differently over time. And I think, like, you see a lot of people who are kind of lost. Again, you could even look at some of the people on the Forbes list and see realizing that maybe they didn't get the meaning they thought they would out of their day job. So for me, I get a lot of meaning studying sort of the bleeding edge of lacking in quite a number of them. But, certainly in biomedicine, sort of being at that bleeding edge and learning about this stuff. And when you learn about stuff in that area, you end up trying to make some of the stuff or build it or extend it or whatever. And, that sort of, will inevitably bring you a lot of wealth. So it's sort of a happy sort of combination. But, I think you have to optimize for the coolness of the information and the coolness of the technology. That's what's fun to me. The fact that it comes with money is a nice bonus, but also, if it starts to sort of take over your day to day, it can be very frustrating. Like, I really look up to the guy like Gabe at Valve, who just, like I mentioned, I think on one of the other teams, just wheels his desk around the office, kind of works wherever, doesn't mind the fact that he's a billionaire, but he doesn't exactly like live his life any differently.
Hey, I'm curious what your take on speaking recessions into existences, and the idea that prices reflect increasing fear in the economy right now, particularly with Jamie Dimon very publicly saying that we're in for a really huge hurricane. I know you said you don't really focus on the macro environment, but just curious if you found it to be true in your career that institutions can speak a recession into existence.
Yeah, really awesome question. And it kind of goes back to Soros's idea of reflexivity, right? That prices reflect information, but also the other way around. Information can reflect prices, which is really bizarre. And in essence, just price changes alone can influence markets or economic activity the same way economic activity influences prices. So it's supposed to be the other way around, right? CPI comes out, employment comes out, data's bad, market goes down. Now it's market goes down, unemployment goes down, goes up, and I think that does happen. That's a real phenomenon. So speaking things into existence typically is kind of a really superficial and kind of superstitious thing. And so ultimately, I do think there is some core truth that we can't observe. It's almost like Heisenbergian, and that we have to sort of as we search for that, we sort of destroy it. If we search too hard. And I think we spend a lot of time thinking about a recession instead of doing something about it. So I don't know. I think certainly the CEO of the biggest bank in the world is, if he's bearish, that's not a good thing. Having said that, if he was if he was a great you know forecaster of that stuff, he'd have a track record that we'd all know about and things like that. It's easy to be cautious when the market's dropping like crazy. He wasn't doing that when the market was peaking like crazy. So to me, I think like everybody has an opinion, and it's not that valuable, even if you are the world's biggest bank CEO. His opinion matters a little more than mine, and maybe a little bit more than yours. But ultimately, I don't think we can really predict what's going to happen next. I think panic is a human thing, and ultimately the market is a collection of firms and actors that are emotional. And so the more emotion and that sort of permeates the system, the higher the chance of different stochastic outcomes like crashes and all kinds of things like that. So yeah, I mean, I do think that there is reflexivity. It is real. It probably manifests in times of volatility and times of uncertainty more than it manifests in times of like placid, kind of slow growth. So I hope we don't speak it into existence. I do think Lloyd Blankfein, who probably did this in response to Jamie Dimon, said that things aren't that bad. We're at sub 4% unemployment. Growth is still pretty good. There's plenty of companies growing 20 or 30%. It's not like shit is hitting the fan as we speak. It sort of looks like there's a risk of recession and so forth, but that's to be expected when CPI is so high. It's reasonable to assume that inflation is transitory, that it is a supply shock. That's sort of a perfect storm of supply shocks or supply chain shocks, I should say. And that it's plausible that this will all be sort of done with in 3 to 6 months. Having said that, I do think we've watered the world with capital, and that contributes to higher asset prices that we saw. I wouldn't say we're seeing, because they've sort of disappeared, but certainly saw across some assets and still see in some assets. Again, whether it's NFTs or things like that, it's hard to call them being that there's a huge recession right now when you can buy a picture of a goblin for about the same price as a luxury car. I think that we still are not quite there yet in terms of like a deep, scary recession. So I think there are still assets that are expensive out there, and there's still plenty of capital sloshing around. Certainly, the big fundraisers you've seen from some funds in the paper recently, and other signs of there being plenty of capital. So we'll see if reflexivity is a part of what happens. Again, one of the hard things about this is that you don't know how much a comment like Mr. Diamond's is really going to impact the market. You can't censor, you can't do a census of people and say, did you sell because of his comment or somebody else's comment? So anyway, that's what I think. Anybody else have any thoughts on that? Maybe 𝗥𝗘𝗢𝗢𝗓, Raul? Or...
Diamond has flip-flopped on his opinion on the economy, 3 or 4 times already this year. I think JP Morgan was actually one of the largest sell side bulls to start this year. They had like a 5,200 price target on the S&P, and then last week he came out and said he's never seen the type of consumer behavior he's seeing now. There's a lot of stuff in question with the global commodity shock, all the issues you're hearing about. So I think it's important to understand that the sell side is going to react after the data is already apparent. And they're not necessarily going to be the ones to give you like predictive measures, although I don't think anybody necessarily can. A lot of them are just going to, talk their own books over the course of how they rotate. So I just think that's, a point that we have to understand here when we're listening to some, larger public figures and market participants.
The point you guys are making about institutional, I call them institutional celebrities, guys like Jamie Dimon, Michael Burry, even Elon Musk, you would call him one at this point, even though he's not a financial institutional guy. He still has a lot of clout. There's the markets now are very fixated on the opinions of these people. But the reality is none of these people are going to tell you to get short unless they're short, right? And same thing with being long. So it is positionally informed more than it is informed by them being able to predict what's going to happen. Like, if they're positioned short, they're going to tell you, yeah, we're short because X, Y, and Z. But Jamie Dimon literally a month ago was saying, or 2 months ago was saying, if I see a hurricane coming, I'll let you know. And now he's saying I see a hurricane coming. So, I mean, he used the exact same language. I just think people overemphasize the opinions of like financial celebrities, and it's
Yeah,
the
he
same
doesn't know.
reason, huh?
Yeah, exactly. He has no clue. Like,
Well, yeah, that's what I'm saying. If these guys knew, then they'd make billions every single financial cycle.
Exactly. Who is he? He's just the biggest CEO of the biggest bank in the world.
No,
like,
no,
who
no,
is he?
no,
Exactly.
don't,
He's a
dude.
nobody. I agree.
Gerg, you're misinterpreting my point. I'm not saying I know more about the economy than Jamie Dimon. What I'm trying to say is that these guys are just like any of these other guys with opinions. It's not that they're all necessarily right. That's all I'm saying. I mean, yeah, they have a wealth of experience, but so does everybody else that's not saying what he's saying.
yeah, he's not a trader. He doesn't know. I agree.
Yeah.
Yeah, it's just not. I just think there's too much credence put into like the things that these people say, rather than just like the obvious things that are in front of you. Anyone who's like logical could have made the deduction. Like if you take all the nitty gritty and all the analytics away and all the, talk about yield spreads and multiple compression. If you really just simplify it, there was a bunch of liquidity in the market and it's not there anymore. That's the best.
It doesn't take a genius to look at the paper and say, yeah, it's bad right now. Like, there's
exactly.
I mean, he'd be responsible.
It's not like complicated. People are trying to overcomplicate it. It's just like there was a ton of liquidity, much more than we needed. I also think people who say we didn't need any stimulus, I think that's equally stupid. But it's just that we did too much for too long, and too much QE for too long, and you had the spillover liquidity. You like you said, Enrique, with people buying. People are still buying pictures of goblins for a couple $1 million. People were doing that with pictures of monkeys back
Maybe
then.
not that much, but
and
yeah.
the point stands of people spending ridiculous amounts of money on basically assets with zero intrinsic value. So I don't even know if you can call them assets.
Space.
But my point is that
$25 million seat to space that you don't even use because you're balling out too hard, like Justin Sun.
Exactly. And so when that stuff was like rampant, we knew there was too much liquidity. And now that it's gone and we're headed into QT, everything just got repriced super aggressively. And I think that's the simplest way to explain it. And I think anybody who's like a noob in the audience who might not be like macroeconomically literate or hasn't traded for a long time, I think that's the simplest way you can understand it too. Inflation got really hot and the Fed got stuck and they had to hike rates aggressively to fight it, despite what the economy was doing. Is it the ideal condition to be hiking rates? No, because yeah, we might stimulate a recession. We'll find out in July, but it still had to be done because of inflation alone. The Fed has to address its mandates, not in a vacuum, but they have to address its mandates as they arise. Like inflation was running to the point where the Fed was like, all right, we have to fucking act on this. There's no other choice. Now, if we see a recession, obviously the Fed's going to reconsider because that's going to harm one of their other mandates, which is maintaining maximum employment. So I think these dominoes are pretty easy to spell out if you just think logically. I don't think you need to be like a wizard in the markets to understand the concept, in my opinion.
So I found it pretty interesting that Nasdaq and Ethereum started moving with a very tight correlation. Do you ever see that decoupling or like that connection disappearing?
This last week.
Correlations go to one usually in weird times where liquidity is driving the bus. So I do think they'll decouple again and we'll get fundamental movements. But when people just want to sell and raise cash, that's what happens. Everyone sells together. When people rush to buy things together, that usually happens too. Usually in a big downturn, correlations do go to one, whether it's a bond, a stock, a piece of artwork, some other utility. Use your imagination. All sort of things drop in price. So that's sort of pretty typical.
Yeah, relative beta, I think, goes down during those times. When you have tightening liquidity, the thing is that, like, when you have excess liquidity like we had in 2020 and 2021, yeah, everything went up, but there were pockets of price action that were dramatically different than the rest of the market. You don't see that as much anymore. You just, like, on down days, you just see a broad dumping of everything, and on up days, you see a broad buying of everything. Not everything, but you get my point. And that's because of tight liquidity. Like when you have excess liquidity, you can have these little, sub markets in different parts of the market where you can see this type of action, and you can have more disjointed price action. But as the liquidity dries up, it's really just influence. It's kind of like people just chasing the move in one direction, which is why you get so much chop.
If you wouldn't mind, could you tell us just what your thoughts are, one, on the markets as a whole, but then two, given your niche, and it's also my niche, what are your thoughts on the biotech sector suffering what seems to be a once-in-a-lifetime crash?
Yeah. So I don't think it's once in a lifetime, but it's pretty bad, obviously. And they should stress you. I think argue that they were a machine that intentionally stresses you to the point where you have to ask yourself if you can withstand the pain for the game. And, just when things are looking the worst and just when things are the ugliest, that's when the turnaround happens, right? And so right now, 30% of biotech stocks are trading below. Yeah, so I was just talking about how, in biotech, there are a lot of great opportunities right now, pretty much objectively speaking. If you buy the sector and don't think about it for 10 years, you'll get a pretty healthy return. But it's still a landmine kind of area, right? There's plenty of zeros, as they like to say, donuts that are out there that you don't want to buy. And there's probably some really big 10, 20 baggers that are out there that if you had the liquidity, you could buy. But the problem is that when those opportunities are obvious to the naked eye, it's usually a time where nobody has liquidity. And it's a sector that not a lot of people want to try their hand in because it's a tough sector. You have to know what you're doing to play biotech. When you just look at some of the ideas on biotech and Wall Street bets, everybody's long the wrong stuff, and it's a treacherous, tough space to be concentrated in. So, but I'd say if you buy the index, you'd be all right. Or if you try to do a lot of research and buy 10 high quality biotechs, you probably do really well. So I think it is the one. I spent 20 minutes talking about how I don't like beta, and this would be one area where I probably would want positive beta exposure to. Again, there's still tons of biotech shorts out there. I mean, there are plenty. So there's no reason where you can't have a market neutral biotech portfolio. I think the hedge fund community kind of stopped shorting. I was talking to one of the biggest biotech hedge fund managers who manages many billions of dollars in assets, and he quit shorting. He just said, "I'm done." This was some time ago that he quit shorting, and I think he was one of the better short sellers out there, actually. And it was just a really tough thing to do to short these stocks, and now you wish you were short, right? So it's just like taking your medicine, having insurance. It's like I meet 25-year-olds who are like, "Why do I need health insurance? This is silly." And the time that you get diagnosed with something or you get hit by a car, you wish you had it. So it's just a funny, dynamic. And I think that, we are probably in a place where if you have a ton of excess capital, I'd much rather have biotech stocks than crypto, for instance, right now. But ultimately, it's all capital and liquidity dependent. Yeah, I mean, there's uncertainty, so prices are dropping. That makes sense. There's uncertainty in inflation. There's uncertainty in, all kinds of different little pieces. So ultimately, it should be no surprise to anybody that